In Lecture 8, we're going to talk about the decision criteria used in capital budgeting. This lecture serves as an overview about the vocabulary used in capital budgeting. We will review the concepts and calculations of some basic capital budgeting methods, including the payback, the NPV, the IRR and modified IRR, and the probability index. We'll apply the capital budgeting techniques to analyze and compare projects, including projects with unequal lives and analyzing a project's economic life. So first of all, what is capital budgeting? Capital budgeting refers to the process in which a business analyzes and determines whether projects such as buildings or a new plan or investing in long-term venture are worth pursuing. This process is very crucial to companies because the decisions may involve large capital expenditures. They have long-term impact and they are not easily reversed once they are made. Usually the steps in capital budgeting include: first, estimate the cash flows, including the inflows and outflows. So this is to determine how much cash flow it would take to implement a given project. You also need to estimate how much cash would be brought in by such project. And second step is to assess risk of the cash flows. And then we determine the cost of the capital, or say the WACC for the project. And the last step is to evaluate the cash flows. We covered step 3, which is about the WACC, in lecture 6. And we will discuss step 1 and 2 in lecture 9, which is the next lecture. Today, we focus on last step. So once we have the cash flow estimates ready, how do we evaluate the projects based on our cash flow estimates? We will use the following basic capital budgeting techniques to evaluate the projects. They include the payback period, the NPV, the internal rate of return, the modified internal rate of return, and the probability index. So we start with the payback period. The definition of the payback period is the number of years required to recover a project's cost or investment. So in other words, how long does it take to get the business's money back? This analysis provides insight into the liquidity of the investment. To calculate the payback period, let's take an example. If we have a project which is the project L here, with estimate cash flow shown on the following timeline. So as you see, it takes an investment of $100, and then year 1, it returns a cash flow of $10. Year 2, it will be $60, and year 3, it will be $80. So to calculate the payback, we follow the following steps. Step 1, we accumulate the cash flows over years. So for example, year 0, that is a negative 100, which is the investment required. By year 1, if we accumulate the two cash flows, negative 100 and positive 10, we get a 90. So this is what we meant by accumulating the cash flows. The cumulative cash flows over years are also shown on the timeline. This number actually suggests how much more do we still have to make to break even. So for example, by year 2, if we add up year 0, year 1, and year 2, the total is a negative 30. That means we have $30 more to make to break even, or say we make enough money to recover our initial investment of $100. Now step 2 is find out when this cumulative cash flow becomes 0. So let's go back to the timeline. By end of year 2, we have a negative 30, and then by end of year 3, we accumulate all these cash flows and we get a positive 50. So some point between year 2 and year 3, this cumulative cash flow becomes 0, and that's the time we break even, or say we recover the initial investment. So step 3, the payback period for this project is 2.375 years, which is the first 2 years plus 37.5% of the third year. How do we get the 37.5%? It is 30 divided by 80. Well, 30 is from the negative 30 of the cumulative cash flow as of year 2, which suggested by the end of year 2 there are 30 more to be made to break even. And 80 is the total cash flows in year 3. So 30 divided by 80, we have 37.5% of third year added to the first 2 years, and that's why we have 2.375 years as the payback for this project. Generally, we use the following formula. As you see, I have A plus B divided by C. So apparently we need to know what is A, what is B, and what is C. A is the last period, or say last year, with a negative cumulative cash flow. So in our example, by end of year 2, this is when you have the last cumulative cash flow, because by end of year 3, it already turned positive. So in our example, A equals to 2. Now B is the absolute value of cumulative cash flow at the end of the period A. So in our timeline, by the end of year 2, we still had $30 more to be made. So absolute value of that is simply 30. So B is 30 in our example. And C is the total cash flow during the time after A. So after year 2, or say during the whole year 3, we expect to receive $80 in year 3. So C is 80 in our example. So put them together, in our last example, the payback period equals to 2 plus 30 divided by 80. And once we get the result, how do we make decisions? The decision rule is to accept the project only if its payback period is less or shorter than the target payback period. And as we will discuss later, this target payback period is a very subjective number. Now, I'll give you this exercise for you to practice with the calculation of payback. If we have this project with the cash flow amount given for each year, can you calculate the payback for this project? And if we follow the formula from the last slide, remember A plus B divided by C. So in this case, end of year 1 you have negative 30. By the end of year 2 it already turned 20. So A is 1, only 1 year. And by the end of the first year, this 30, the absolute value is 30. And for the whole year of year 2, the total amount to be made is 50. So 30 divided by 50, that's 60%, or say 0.6. So altogether, it's about 1.6 years. So for this project, it takes about 1.6 years to recover the initial investment of $100. Let's talk about the strengths and weakness of the payback period. The strengths include that payback period provides an indication of a project risk and liquidity. It can be a measure of risk in the project, since cash flows that occur later in the project's life are considered much more uncertain. Payback period provides an indication about how certain the project cash flows can be. For companies facing liquidity problems, this payback period also provides a good ranking of projects that would return money sooner, or say earlier. And we also see that payback period is easy to calculate and easy to understand. The math is pretty straightforward. You just add up the project's future cash flows and compare with the cost. We also need to understand the weakness of the payback. First, it ignores the time value of money concept. As you have already seen, payback period does not take into account the time value of money, which is a serious drawback and can lead to wrong decisions. Remember, it simply add up all future cash flows which occur at different years and subtract from the cost, which is at time 0. So this is a violation of the time value of money concept. In addition, the payback ignores the cash flows that occur after the payback period. Sometimes the most profitable projects take more time to reach their full potential. But if the company has set a strict time limit on payback periods, then it may end up rejecting a very worthwhile project. The next capital budgeting technique we want to talk about is the net present value, or say NPV. A project's NPV is the sum of the present values of all its cash flows, among which CF0, or say cash flow at time 0, refers to the cost or initial investment and usually is used as a negative number. Therefore, we can also write the formula in this way. So the difference between these two, as you see, on the first one it starts with 0, so it includes all cash flows from time 0. And in the second equation, we start with time 1, so this part includes all future cash flows to be generated by the project. And we sum up all the present values and compare with the initial investment at time 0. So if we look at the project L again and use this 3-year project as an example to calculate the timeline, when the discount rate is 10%, what is its NPV? The easiest thing to do is to calculate the present value of every future cash flows and sum them up. Apparently, the present value of the negative 100 at time 0 is negative 100, and then the $10 after year 1, the present value is 9.09, which is 10 divided by 1 plus 10%. And for the second year's cash flow, you use 60 divided by 1 plus 10% at the power of 2, you get 49.59. And then for the 80, you use 80 divided by 1 plus 10% at the power of 3, you get 60.11. And you add up all these numbers, positive and negative, you get a total present value of 18.79, and that is the NPV of project L. If you look at the project S, which is the other project with a timeline like this, you can also calculate its NPV under 10% discount rate, and it will be 19.98, a little bit higher than the NPV of project L. So as you see, NPV calculation is something old that you have learned from our previous lecture, lecture 4. We simply calculate the present value of every cash flow and then add them up. We can also use a financial calculator to get the NPV results. The next slides show you the inputs used in your financial calculator. If you want to refresh your memory about how to use the financial calculator to calculate NPV, I have a video posted on D2L regarding this, so check out that video and you can practice using that financial calculator to calculate NPV. So with your financial calculator, negative 100, that's your input for the CFO, and CO1 will be 10, CO2 will be 60, CO3 will be 80, and in case you're looking at your calculator and all those FO1 will be 1, FO2 will be 1, and FO3 will also be 1. And then you try to compute NPV when I is 10, that means 10% discount rate. You compute NPV, you get 18.78. Again, if you want to practice using your financial calculator, check out that video posted on D2L about the use of financial calculator. So what's the rationale for the NPV method? NPV, net present value, is the present value of cash inflows minus the present value of cash outflows. This is a net gain involved. So we should accept project if NPV is greater than 0. If we have two mutually exclusive projects, then we should choose between these projects on basis of higher NPV, since the one with higher NPV would add most value for the company and for the shareholders. In case you need to understand what are mutually exclusive projects and what are independent projects. Let's see. Projects are mutually exclusive if the cash flows of one can be adversely impacted by the acceptance of the other. This means these projects cannot be undertaken simultaneously. Only one project can be accepted, and if you accept this one project, you do have to reject the others. The other kind is the independent projects. Projects are independent if the cash flows of one are unaffected by the acceptance of the other. So that means you can take one, and taking one does not mean you have to reject the other. This is the difference between independent projects and mutually exclusive projects. Again, mutually exclusive projects means if you choose one project among them, you have to give up or reject the others. So if we have two projects here, project L and project S, they are two mutually exclusive, then according to the NPV results, we choose S because NPV of project S is higher than NPV of project L. However, if they are independent, then we can accept both because then we look at each of them independently. And both projects have positive NPV, that means we can take both projects. We can accept both projects.